Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. Let's get you up to speed on the market action with 1 hour left to go in the trading day. The Dow is up 52 points. By the way, looking to notch its 12th straight day of gains. The S&P 500 up 17 and the Nasdaq up 104. We're watching bond yields very closely with the FOMC meeting kicking off. That big rate decision coming down tomorrow. You see the 10-year yield right now at 3.9 and the 5-year up above 4%. And then, of course, we're looking at sectors. Tech leading the gains today as we look ahead to some big tech earnings out today after the bell. And Brad, we've got our eye on Microsoft as well as Alphabet. It's going to be an interesting one because this is really the first test since we've gotten so much attention on artificial intelligence. Both of these names, investors are going to have questions. How much can they actually generate? Beyond the excitement, I would argue probably too early to tell based on this latest quarter results, but we'll see how the reaction goes.
Hype phase last quarter. This quarter, it's a show me story. It's going to be about where all of these companies are able to spell out just how much they're spending on some of these efforts as well here. Now, we've been kind enough for the folks at home to break out some of the key things that we're watching as well for these earnings here.
Yeah, in Microsoft, obviously a big one given their investment in OpenAI's ChatGPT. It was just last week where they talked about the subscription model for Microsoft 365 Copilot, essentially $30 a month subscription there. So we saw shares rally on the back of it. This is a stock, by the way, Brad, that is up more than 40% on the year. There's going to be a lot of questions around AI. How do you monetize that? What's the growth prospect? But also Azure's performance, because we have seen fourth straight quarters of declines. A lot of companies pulling back on some of that cloud service investment. What does that look like in this quarter? A big question mark for Microsoft.
I'll just put some numbers on that cloud expectation as we're going into, of course, we've got about an hour left in trading here, but for that cloud segment that you mentioned, commercial cloud expected to bring in, by some of the Bloomberg consensus estimates, about $30 billion there. Intelligent cloud expected to bring in $23.8 billion, and look for a gross margin percentage of about 70% for that business also. Another report out today, Alphabet, I'm watching advertising revenue growth, plus what that generative AI spend looks like. All right, so Alphabet wasn't exactly first out of the gate when it came to generative AI and some
of a bumpy rollout for Bard.
Yeah, I mean, it doesn't even flow off the tongue at the end of the day. Bard versus some of the other major names. I mean, we're looking at the humanization efforts of some of the AI efforts out there. But at the end of the day, I think for Google and what we're going to be watching more closely here, keep an eye on what that revenue ex-TAC looks like as well. $60.23 billion is where they're expecting that to come in, or at least the consensus estimates expecting that to come in at. That's that traffic acquisition costs. And then additionally, EPS, we're looking for that to come in at about $1.32 a share. Also, just keep an eye on YouTube too. We're talking, of course, about Alphabet and Google and the subsidiaries of Alphabet, and you can't take your eye off of YouTube, especially considering a lot of the attention, or at least the wars for screen time that continue to move forward, which is going to come into the fold with another company that reports after earnings today too. And so YouTube, those active users expected to be at about 2.75 billion, but the revenue 7.41 billion as well.
Well, YouTube increasingly competitive with some of the other streaming services as well. Can they take advantage, although you don't want to say take advantage of the opportunity in terms of some of the strikes that are happening right now, especially in Hollywood. What's going to be interesting to me with Google specifically, you talked about the ad spend, digital ad spend, that's obviously the big driver. To what extent does the chatbot, Bard's chatbot, disrupt the ad spend? Because that's been the concern. Are users not necessarily going to go for search in Google, but ask for sort of the questions, right, using their generative AI technology? Is that going to cannibalize some of the user base, some of the money that's going towards digital ads? And that's been a big question mark because they've got two products, two pipelines going right now.
And even if we don't see, to your point, the strike that you mentioned a moment ago, even if we don't see that be a long-term strike for actors and writers, where have people continued to go back to get their content? It's user-generated content platforms like YouTube, where people such as Issa Rae got her start on YouTube, really just showing off that ingenuity, that creative ability, and taking it directly to some of the viewers and building up a following that way. And so it would be interesting to see how Alphabet, or YouTube in this instance, also looks at this period and senses an opportunity for creators that are out there. And if they're able to layer on generative AI correctly to some of those features, how they can make it that much easier for creators to be able to reach the masses.
Specifically specifically on the content creators, the influencers that we talk about. I mean, that's an interesting conversation that's happening because a lot of them aren't necessarily members of SAG-AFTRA. They see an opportunity to get in on content. It's a bit of a tricky conversation that's happening. Another company that we're going to be watching after the bell today is Snap. The stock always pretty reactive to earnings, specifically digital ad spend, another big one here in terms of Snap. And then, of course, competition. We talk a lot about Snap's competition with TikTok, Instagram. Now you add Threads to the mix, although Threads is more text-based. You have to wonder how much of that is actually going to disrupt into user base. But Snap is always a really volatile one around earnings in terms of the stock.
Yeah, I mean, I love talking about this company when it comes to earnings time because it's always kind of a toss-up coming into it. You could totally expect one thing. You could expect for them to blow it out on the water, out of the water on some of those daily active users, by which they're expecting about 395 million, or at least the street is here. But one of the other kind of competitive things that you were mentioning that we need to watch out for is something more recently that came out, which is with regard to TikTok. According to reports, TikTok Shop is something that the company is hoping or looking for to have similar to success to some of the other shoppable websites out there, particularly overseas in China as well, such as Shein and Temu. And so that potentially coming as early as August here for TikTok, and could be one of those major acknowledgments that a company like a Snap or any of the other social media companies have to make as well.
Yeah, how sticky does it make the platform,
Sure,
right?
yeah.
Another feature to add to the list there. Now, in addition to all the earnings we're watching today, we are under 24 hours away from the next FOMC decision. As it's widely expected, the Federal Reserve will raise interest rates to the highest level in 22 years. For more on what this means for markets moving forward, we want to welcome in Blake Gwynn, RBC Capital Markets Head of Rate Strategy, as well as Jeremy Schwartz, Wisdom Tree Global Chief Investment Officer. Blake, let's start with you here in studio. As we think about where things are likely to move beyond the meeting tomorrow, the expectation is another 25 basis point hike. Will there be a second one down the line? What are you looking for?
Yeah, that's a big question. I think tomorrow, I wish I had a big juicy headline for you guys, but I think it's going to be relatively quiet. We all know the 25 basis point hike is coming. Also keep in mind at this meeting, we're not getting an update to those SEP dot plots, as we call them. They give us some idea about what they're expecting down the road. The last version we got in June did suggest that they were going to hike again, but so far markets have not really bought on to that idea yet. If you look at trading in the Fed funds futures contracts, it's still suggesting that markets don't really see that September, November additional hike happening. So I think people are going to be really keyed in tomorrow to Powell's press conference, just listening to see if he gives any kind of signaling one way or the other. Personally, I think it's a little bit too early for that. We still have 2 NFP prints, 2 CPI prints before September. So I just don't really see a reason for him to start pushing markets one way or the other, or to start closing down their option set as they move into that September meeting. There's a lot of data and a lot of time to make that decision on what to do after the July meeting.
Jeremy, what about you? Is tomorrow business as expected? And if so, how can investors best position themselves to anticipate the Fed and what their tenor may be in signaling the future?
Yeah, I agree. Tomorrow's not a major story, not a lot of major surprises. We do think the Fed's making a mistake in a sense. We think they don't need to keep hiking, that inflation is on its way down. Now, we've been surprised actually how resilient all the markets have been, the labor market, the housing market. We got another CaseShiller housing data point this today, 4 months in a row of increases after 7 months of declines. That's been one of the feeders into our view that inflation's already coming down, was for the downward trajectory in shelter inflation. But hopefully they don't keep going too much. I mean, the higher they go, the more risk they do put us into a deeper recession than necessary. But we got to admit that the market and the economy's been resilient to all these higher hikes.
Let's talk about sort of the macro conditions that are driving all this, Blake. We got the IMF today upping their growth forecast. We're talking about 3% for 2023, now 2024, 3% as well. As you look at the economic data, I know you said that you think it's too soon for the Fed, given what we know right now, but are we starting to see the real possibility of a potential soft landing? In other words, are we starting to see sort of inflation pull back at a pace that maybe the Fed is a little more comfortable with?
Yeah, absolutely. I think the soft landing is quickly becoming somewhat of a consensus in the markets, which is pretty shocking when compared to where we were 2-3 months ago post SVB. People were very, very cynical on where the U.S. economy was going, and I think people were pricing in cuts as soon as the summer. That has clearly not turned out to be the case. Jeremy mentioned a lot of the positive data. I think if you're looking at the Fed and kind of thinking where they are relative to June, I think some people might be expecting them to soften their tone because the inflation data did come in a bit weaker. But if you look at the totality of the data and what's been happening on jobs, what's been happening on consumption, it does look like this soft landing narrative is coming to play. It was often derided as immaculate deflation, but that's what we're seeing. Inflation's coming down at a pretty healthy rate still. And meanwhile, we haven't seen that pain on the labor market or growth data that I think a lot of people thought had to go hand in hand necessarily with that slower inflation.
So that means, Jeremy, possibly a end to this airline analogy that we've been using for the better part of about a year at this point. So we'll have to find something new. But at the same time, it brings in this larger question of, okay, so if soft landing, then rally on, and if so, where should investors be positioning their portfolio?
We had been getting more cautious. We're starting to upgrade our view of the economy, actually, and that would actually lead you to some rotation away from what's been working right now. What's been working has been growth in all the AI stories. If you view that the economy is not going to go into recession, you could go to the more cyclical areas like small cap, value, which are pricing in a recession in our view. If you avoid the recession or even have a softer recession than people thought before, this could be a return to sort of the cheaper price segments of the market. And that's one of the things we're looking at for the latter half of the year.
And Jeremy, as we look ahead to after hours earnings today, we were talking about some of the big tech names that we're watching that have largely seen their valuations balloon on the back of this excitement around AI. I mean, where are you positioning yourself on that front? What does the tech thesis look like?
The higher the multiple, the higher the expectations, and the easier it becomes to disappoint a little bit. We're writing a piece right now on NVIDIA that is 40 times trailing sales, 25 times forward sales. If you take those optimistic estimates of where they came, the probability that they can outperform from 25 times sales is not great over 3 to 5 years. Less than 10% of companies that got to that multiple went on to outperform over 3 years. In the short run, perhaps the momentum continues. But if you're saying the next 3 years, I think it becomes much harder. But generally, all the big tech, they're selling at 30 times earnings. The rest of the market's much cheaper. To me, I'd prefer things like 12 PE high dividend stocks than the 30 PE tech stocks at the moment.
Stay with us, guys, here, because one thing that we also have to talk about is something that came out this morning in terms of economic data, the Conference Board's Consumer Confidence Index for July. That hit a reading of 117. This is the highest level in 2 years as consumers are feeling increasingly confident about the current state of the U.S. economy. Blake, do you expect this trend to continue?
Look, I do think consumers are going to start slowing down. One piece of that data that I think was a little bit overlooked was the percentage of consumers who said that they were planning on cutting back, in the future. And that is actually still showing a meaningful number of people who are planning to cut back. You kind of couple that with the idea that student loan repayments are going to start, which is going to bite into people's ability to spend their kind of monthly budgets. I think both of those things combine to start pulling back consumption into the end of this year. And we do have a little bit slower growth in Q3 and Q4. But still very far from what I would call a recession or a capital R hard landing type of recession. It's just very slow growth, and then in 2024 actually comes back into positive territory. But that is driven in part by this slowdown in consumption that we're expecting later this year.
Yeah, are we starting to see maybe more of sort of that divide narrow? We've been talking so much about the consumer confidence versus the actual spending that we're seeing. The divide that exists there, maybe that's starting to kind of narrow here as sort of consumers look at pulling back further and seeing the reality.
It is, and I think over this last year and over this cycle, I think a lot of people have rightfully become a little bit more leery of this kind of survey data that a lot of times doesn't really seem to match what consumers are actually doing. And you could say the same for businesses as well. So yes, those things are perhaps coming together, but we do think going forward that is going to start to slow.
Jeremy, how does this show up in terms of some of the companies that we're going to be watching who are reporting earnings today? And they've got 3 months worth of data plus some of the current quarter to look at to get a real-time pulse check of the consumer, whether that be in their purchasing patterns on their e-commerce sides of their website, whether that be in how much they're engaging even in social platforms with brands with purchase intent. So, where can we really look through some of the data that comes out today during earnings to signal or give us some type of sense of the pulse check of the consumer as well?
I mean, what I hear on these tech companies is increased spend. They're spending to make these AI investments. The question will be what the revenue comes in the future. NVIDIA, the semis, they're the direct play for what are people buying? They're buying these AI chips so they can do all this stuff. Hopefully adding new business opportunities for these tech companies. It's too early, though, to see it fully come to play. And so that's where I feel like expectations might be a little high at the moment. But we'll have to see how it shows up. I mean, you're going to need to see revenue to match all the spending that's expected for AI. And I think it's just early in that transition.
All right, Blake Wynn, RBC Capital Markets, head of rate strategy, as well as Jeremy Schwartz, who is the Wisdom Tree Global Chief Investment Officer. Thank you both for the time here this afternoon. Really appreciate it.
Thank you.
And we're just getting started here on Yahoo Finance Live. Coming up, strike averted. UPS and the Teamsters reaching a new 5-year collective bargaining agreement. We'll break down the deal and the impact on the company straight ahead. Plus, home prices rising again in May. We're hitting the latest housing hurdles later on in the hour. And as we mentioned, earnings season rolls on as big tech gets started with Microsoft and Alphabet after the bell today. Plus, Ghostface Chiller and Snapchat as well. Of course, they wanted to be mentioned. We'll be right here to break down the numbers and all the stock moves. Stick around for much more when Yahoo Finance returns.
Let's do a check of the markets sponsored by Tasty Trade. We are looking at all three majors in the green right now, with the Dow on track for its 12th straight day of gains. The S&P 500 up 20 and the Nasdaq up 121. We're also taking a look at the VIX, the fear gauge, as we like to call it here, up just slightly there at 1403. Well, UPS and the Teamsters Union reaching a tentative deal just days before their contract was set to expire. The Teamsters saying agreement adds $30 billion of new money, while UPS isn't confirming those numbers. CEO Carol Tomei says the deal is a win-win-win agreement. Shares of UPS dropping on the news. Joining us now is Third Bridge senior analyst Anthony DeRuyter. Anthony, you could argue crisis averted for UPS, but in the long run, this does increase the cost pressures for the company. How do you assess the agreement that came down?
Hey guys, thanks so much for having me. So yeah, when we talk this UPS Teamsters deal, it's best to frame it in terms of pros versus cons. So pros, obviously, the customer and shipper churn, people were worried about, if service were to be impacted, that should be largely mitigated, given that service should continue as usual now. Our experts had previously estimated that, up to 10% of the UPS business could have been immediately up for grabs, if not more, depending on the strike duration. And, there are UPS numbers out there saying 170 million per day of revenue, apply 12% op margin. What's that? 20 million per day in op margin and op profit adds up. Now, the cons, though, as you pointed out, is that this is likely to be very cost inflationary, right? If we talk about the terms of the deal, higher part-time pay, no two-tier wage system, outfitting the vans of AC, for example. It's clear that costs are going to go up for UPS, and that eats into their margin outlook for the year. That wouldn't be an issue if they could pass on those costs, but our experts don't think they can, just because the shipper base is sensitive right now. They could lose quite a bit of business if they try and use yield as a lever. Now, one last thing to point out, longer term, the question is, in 5 years' time, what do they do? Are shippers going to stick around for the same drama? Will Teamsters be similarly powerful? Big questions.
So should investors, based on at least the data that we know right now, which there is very minimal of, just the statements that we've seen come through, should they be confident in the fact that a deal was done ahead of this deadline that was looming, or should they be kind of kicking the tires on this one once we get a little bit more about what the actuals were that was necessary for them to kind of forfeit or make sure that they were conceding in order to reach a deal?
So I guess, again, the positives would be that had UPS not reached a deal with Teamsters and a strike event happened, any business that would have been lost, our experts indicated that would have been permanently lost, or at least very difficult to get back. So I think the positive for UPS that investors might look at is that there's top line that's going to stay put. Obviously, the cons is how are they going to deal with the margin compressive factors that I outlined earlier, right? I mean, if they can't price it through, they're going to have to eat it themselves. And that's obviously something that they're going to struggle with, especially if markets stay soft like we saw in Q1.
Let me pick up on that point about what we saw in the lead up to a potential strike. Volume levels did go down because a lot of customers were seeking out alternatives. To what extent does that business come back automatically as a result of this? And to your point, yes, cost pressures, but it's also about boosting efficiency to compete in the market. How do you think UPS is positioned?
So with the first point, from what we've heard, a lot of the business that was sniffing around at other carriers, so say FedEx or On-Track Lasership post-merger, or even the Postal Service, a lot of that was looking for an alternative carrier, so it may not have been actually lost, and perhaps now that risk is abated. On to your point of operating efficiency, obviously for UPS, if they keep those volumes, they can leverage their network more fully and realize those efficiencies. So they haven't lost the volume to sort of backstop that, right? If they had lost that volume, they would have definitely, they would have potentially experienced a loss of scale economics.
Anthony DeRuyter, appreciate you joining us today. Thanks so much for your time.
Thank you.
Well, the UPS tentative deal preventing 340,000 people from hitting the picket line. But it's been a busy summer of strikes. According to Bloomberg Law, 322,000 workers have gone on strike this year, including the Writers and Actors Associations and their unions. So we could see more as the UAW contract expires in September. Joining us now is Art Wheaton, who is the Director of Labor Relations at Cornell School of Industrial Labor Relations. Great to have you here with us today. Perhaps we could start with the deal that just got made between UPS and the Teamsters here. I would love to get your instant reaction to it and what this signals about the broader state of union negotiations.
I think it's fantastic. I'm delighted that we don't have a disruption in service. I think that the Teamsters were able to win quite a bit at the collective bargaining table, but I also think UPS did a fine job as well. So the strike was averted. They have a few days left to go before the contract actually expires, and the process works.
Well, we have heard from other unions, not specifically on UPS, but just the strikes that are happening, is that there is a lot of unity among labor unions, whether it is in Hollywood, whether it is in Detroit, where we're having a UAW negotiation right now. I mean, can you talk to me about where you think the workers' leverage lies. We've been talking the last year about how workers have the leverage because of a tight labor market. Is that what's driving a lot of these strikes that we've been seeing play out?
It's always a combination of different factors. Number one, you do have a tight labor market, so unemployment rates are lowest they've been in decades. You also had a history of high inflation, so everybody is looking at the bargaining table as a way to make up for all of the costs and the increased cost of living. So that's also a factor. You had, it's been a huge COVID and logistical nightmare for our supply chain for the last few years. And this is the first opportunity to negotiate a contract post-COVID emergency. So that's part of it. And you have very, very high positive union approval or the feelings about unions, the highest it's been since about 1965. So you have very high approval ratings. You have a president in the United States trying to claim he's the most union-friendly president ever. And unfortunately for us, depending on who the president is, can have an impact on the National Labor Relations Board and how things are managed. So currently we have a more union-friendly president, and that means the labor law tends to be a little bit more friendly towards the NLRB. All of those factors come into play.
All right, I imagine the answer is different for every different union negotiation and as it plays out to the consumer related here. And I'm bringing that up because consumers might be thinking, okay, so who eats that cost? Is it me who's paying for a service, or is it the company that may have seen their profits be able to be buoyed or even balloon over years, or corporate executives that have seen their own kind of bottom line or compensation balloon over years between the negotiations of different contracts? You know, is it as simple as saying that the corporations need to eat more of this, or where the consumers should expect or can expect some of that cost for, you know, labor costs to be factored or sent through to them?
I think the consumer is very well aware that there's been inflation and some costs go up, and people think everyone deserves a decent wage. So of course there are going to be some cost sharing, but the part of it that you haven't mentioned is the increased revenue or increased productivity. So by having the labor deal done, you're not losing all of those customers, so you're gaining that back. And also, if you keep your workforce around longer, they will usually be more productive and know their jobs better and how they're doing it. You can increase on the productivity side as well. So it's not all pure cost. You do get gains by having a stable work environment, and you're not trying to desperately find new employees that don't know how to do the job as well.
Art, wages and benefits certainly, you know, sort of top of mind in so many of these negotiations, but there's also, it appears, a common thread when you think about what's happening with, for example, the UAW negotiations, what's happening out in Hollywood with SAG-AFTRA and WGA, and it is about a change that is happening, a technological change. In the case of the car makers, it is about electric vehicles and what that means for job stability, what that means for future skills. Same thing in Hollywood. When you think about those particular issues, how strong is the hand of labor unions right now?
It's strong in the hands of labor unions, at least on the part of the UAW, a little bit less so for Hollywood and for the writers and for the actors. But technology has been an issue for generations. It's not a new phenomenon. The last time the actors went out on strike, it was also technology driven, and it was whether it was VHS tapes or trying to get those recordings, and you did have the cable programs doing it. So technology continues to be an issue. For the auto industry, the problem the UAW is facing is that the transition to electric vehicles and the batteries that are the biggest cost for those electric vehicles are being made in joint ventures. So the UAW can't have a strike against the battery manufacturing component of it, because it's not owned by General Motors or Ford. They're joint ventures. So by the nature of it being a joint venture makes it a more difficult time to bargain against the battery components. But there is a lot of strength for stopping the building of trucks and SUVs, which are in pretty short supply at the moment.
Great insight and context there, Art Whedon. I also haven't had to think about VHS videotapes in quite some time, so thanks for the trip down memory lane. Appreciate it here this afternoon. Thanks.
Well, possible deal brewing in the banking sector. Bank of California reportedly in talks to acquire PacWest. Jared Blickery here with a closer look. Steep declines when you look at shares of PacWest right now.
Yeah, it's the whole banking sector, the whole regional banking sector under a bit of pressure here. The two entities we're talking about are very small. So PacWest down here, that's down 25%. I'll show you some larger charts in a second, but just kind of illustrate the size here. Bank of California up 11%. And just looking at the market cap, PacWest is now under $1 billion. And you might be asking yourself, why is a smaller company, Bank of California, potentially buying out a larger bank? I'm just speculating here. Could be some issues because PacWest has been selling off assets rather aggressively over the last 3 months. Now, here is the intraday chart. There have been multiple volatility halts since the announcement. It looks like we're caught in another volatility halt right now. But I want to show you what's been happening to the entire regional banking sector over the last 3 months. If we sort by performance, we're going to notice something. Only a few names down here are in the red. PacWest is among them, and you can see now it's trading again, down 22.6%. Things are developing quickly here. Here's Bank of California, up 29% over 3 months, and it looks like we got a couple names down here. I don't want to spread rumors, but might be in similar situation. Both of these entities, Bank of California and PacWest, going to announce their earnings, or at least they're slated to announce their earnings after the bell. I would expect that we're going to get some details on this, but we really don't have many details yet. This comes from a Wall Street Journal report. They're saying that Centerbridge Partners and also Warburg Pincus are going to contribute equity to the deal, and then the only other person or entities that are going to supply equity or funding are PE groups, and that includes potentially our parent company, Apollo Global Management. Aside from that, just speculation. So we'll be waiting for more news on that probably after the bell, guys.
Yeah, potential for yet another shakeup in the space there. Jared, thanks so much for that. Well, coming up, shares of GM riding downhill today as earnings season rolls on. We're going to dive into the numbers and the second half outlook for the autos giant on the other side of the break. We'll be right back.
Home prices extending their gains. New data from the S&P CoreLogic CaseShiller Index shows prices gaining 0.7% in May. That's the fourth consecutive monthly increase. Joining us now, we've got Craig Lazar, who is the S&P Dow Jones Indices Managing Director and Global Head of the Index Investment Strategy Group. Great to have you here with us, Craig. Here, help us break down some of the data from this most recent month, but as well the broader trend that we're seeing locked in.
I think that the most helpful context I can give you is to point out that home prices, at least in our national index, seem to have peaked almost a year ago in June of 2022. They then declined through January of this year, 2023, so about a 6 or 7 month period of decline. And that total decline amounted to about 5% from peak to trough. Since January, we've had now 4 consecutive months of increases. In fact, this month's release, or today's release, which was for the month of May, made it 4 months in a row, and we have seen increasing prices. So pretty clearly, looking at those data anyway, you would say the decline that looked like it probably had ended in January, it's ended in January. We're now clearly in an uptrend. Second thing to say, I think, is that the increase is very broad. We monitor not only the national composite, but also 20 individual cities, and every one of the 20 was up in the month of May and also in the month of April. So it's not a decline or a gain that's concentrated in 1 or 2 areas, but instead is quite broad. I guess the third thing to say, and this is always among the most interesting things when we look at these data, is that the regional differences are quite striking. I mean, for literally 5 years until this month, the city with the largest year-over-year gain had been what I think of as a war. Vegas for about a year, and Phoenix for nearly 3 years, and last year or so, it's gone back and forth between Tampa and Miami. This month, Chicago and Cleveland in second place. So we're seeing a resurgence of the Rust Belt in these most recent data.
So, Craig, when we're talking about 20 cities, obviously, individual storylines going on there as well. But the national picture, is there a snapshot here where you can point to say why we are continuing to see the rebound? What's driving it?
Well, I think a couple of things. One is that the rapid increase in mortgage interest rates that we saw last year has come to an end. I mean, when I say rapid, I mean we went in the space of maybe 6 months or less from a mortgage rate with a 2 or 3 handle up to something with a 6 or 7 handle, and it's kind of stabilized after that. I think it ticked up a bit today. But we're still relatively stable compared to what was going on a year ago. So there hasn't been that rapid increase in rates, and obviously the more mortgage rates go up, the less affordable houses become, and the less able people are to buy them. The second thing is that as the economy has evolved over the last say six months to a year, it looks increasingly as though the Federal Reserve will be able to pull off what I think they would call a soft landing. In other words, a reduction in in inflation rates without putting the economy into a full-fledged recession. Obviously, if there is it influences people's incomes negatively, it negatively affects houses. We haven't had that yet. So the fact that the rates seem to have flattened out, if not decreased, and the economy is still reasonably strong are both good things for the housing market. The additional factor, of course, that everyone who studies this is aware of, is that because so many people either bought for the first time or refinanced several years ago when mortgage rates were in the 2 to 3 neighborhood, for those people to move and move up even to a larger house, even if they need a larger house, becomes much more expensive because they not only have to pay for the larger house, they have to pay for a much higher cost of financing. So the increase in rates so rapidly after a very low, prolonged low set of rates makes it harder for people to move, reduces supply, and therefore supports prices.
Craig, just lastly, while we have you here, where in terms of volume right now, even across the pricing, metrics and fluctuations that might be taking place, where is the highest propensity to continue to bid into the home buying experience from what you're seeing?
The only way I can answer that is by looking at the city by city data. And I mentioned earlier the Midwest was the leading area this month. Prior several months it had been the Southeast. For the last at least 6 months or so, the weakest area has been the West. I mean, Seattle and San Francisco are the two biggest decliners on a year-over-year basis. And I come back to trying to explain that to say, well, if you look at any set of data on migration within the United States, the coasts are losing population. California, I think, lost population last year for the first time in the history of California. So if population is declining in relatively expensive, relatively high tax areas and migrating to relatively less expensive and taxed areas, that would suggest support for the Southeast and Midwest, which is what we've seen.
Craig Lazar, thanks so much for taking the time here with us today, breaking down some of the latest economic data around the housing market. Really appreciate the time and context.
Well, shares of General Motors under pressure in today's trading session, despite reporting a beat on the top and bottom line. The stock there down more than 3%. The car maker wrestling with costs and building more electric vehicles. Here are the details. We've got Yahoo Finance's Pras Subramanian. Pras, a number of headlines coming out of this call. Number one, news on the Bolt, but also this supplier that GM has sort of identified, saying that's kind of slowed things down for them.
Yeah, so, look at the numbers here. Huge top line beat, 25% year-over-year growth in revenue, like a nice strong beat. They're upping that profit guidance again for the second time this year. And the way they're doing that is they're extracting some costs out of labor and marketing costs and things like that. Also, we'll talk more about this, but they're actually able to charge more for each car. But the big thing you mentioned is why is the stock down? I think it has to do with the fact that there's issues with their EV sort of runway. They want to make 100,000 EVs in the back half of this year. They still say they're on target, but there were some issues with a supplier that makes the modules. Here's Mary Barra earlier today on that problem.
We've also added additional lines because we don't want module production to gate our launch of all the products that we have coming in the second half of this year and continuing into next. And we know we're going to need that module assembly capability anyway as we continue to grow beyond the 400,000. So disappointing. I've personally been reviewing the lines. As you know, I spent time in ME earlier in my career running it. So we'll get this behind us. I'm very confident of the teams we have in place. So you'll see it improve as we get through I would say into the end of third quarter, beginning of fourth quarter, and then I think it will primarily be behind us by the end of the year.
I was surprised to hear that she said, I'm personally getting involved, going to the lines. She used to be a mechanical engineer herself, going there and wanting to see what's happening here, why the module is not operating. They're sending GM engineers to their supplier to get those lines up. So that's how concerned they are about the ramp up. And I think that was sort of the moment for investors.
Yeah, talk about having your hands on the pulse of where perhaps there is the largest pain point, at least right now, in terms of hitting some of those goals. So does it throw them so far off target that it's changing investor sentiment out there at all?
I think it might. If you're looking at the movement today, it's a little down on actually a strong, I thought, financial performance. So maybe there's some concern there. But both Mary Barra and CFO Paul Jacobson said they're still on track to make those 100,000 EVs, make 400,000 by the end of 2024, and 1 million, I think, by the end of 2025. So they're saying they're still on track. I think there's some doubt as to whether that's going to happen.
Yeah, I mean, the company's really touted 2024 as sort of a big year in terms of this transition to EVs. But we've seen competitors cut prices. Did we hear anything from GM on that front in terms of how comfortable they feel in their pricing strategy right now?
So they're talking about how their ATP, or average transaction price, went up $1,400 in the last quarter because there's strong demand for the ICE products, right? For the EVs, they're not talking about, they're saying that their prices are fine right now. We've only heard ballpark what they want to charge for their 3 upcoming EVs now, the Silverado, the Blazer, and the Equinox. So they think that they're competitively priced. But once those cars come on the market, we'll see, right? You could get a Tesla Model 3 for $32,000 after the EV tax credit. You can get a cheap Volkswagen ID4 EV. So we'll see what the customer does when they see the Equinox versus these cars. So I think that'll be the proof, is when these cars are on the market, are they going to adjust pricing, especially if Tesla goes on the rampage again and cuts even more.
Yeah, we were just talking the other day, right, about whether they keep the Volt and how we've seen more and more sort of higher price point cars coming out, whether that's kind of where they're doubling down. So interesting commentary coming out of GM. Thanks so much for that, Praz. Well, coming up on the other side, pain at the pump. Gas is ticking up slightly, but it's not just the price of the oil that's kicking up costs. More on the latest crude awakening when Yahoo Finance returns.
Gas prices are ticking up slightly. The national average for regular fuel is up around 7 cents over the past month, but it's not just the price of oil that's kicking up costs. Yahoo Finance's Rick Newman has the story. Hey, Rick.
Hey, guys. I came across some economic research recently into profit margins on gasoline sales. And I knew I had to look right into this because of all the conversations I've had with our audience members and drivers about why are gas prices so high? Who's making out when gas prices go up? So it turns out, if you think that that retailers are charging more relative to the wholesale price, you're actually right about that. The profit margin on gasoline is about 77% higher than it was in 2019, and the profit margins have more than doubled for a couple periods in the post-COVID era. So. Yes, retailers are taking a bigger chunk of the price of gas as a profit margin. And before everybody goes howling about how much gas stations are ripping off drivers, keep in mind, we have pretty tight supplies of gasoline. We have a limit on refineries. There's basically a ceiling there. So we don't have as, supply is pretty tight, and that actually gives retailers pricing power. This is what some people have been calling greedflation, and it is kind of a thing.
Greedflation, as in when companies set the prices artificially, right? Because of this expectation that prices are going up.
It's the price. I mean, let's remember, in capitalism, producers at the wholesale level and retailers selling to consumers, everybody wants to sell their product for the highest price they can get. Usually competition, it helps bring prices down because people, sellers compete with each other. But when you've got strong demand, which we have because Americans have been buying stuff like crazy and now they're out and about and traveling and buying gasoline. And when you have tight supply, those are the two factors that actually give sellers pricing power. So that's why they're able to charge these prices.
Really quickly, Rick, this is a question that always comes up when we talk about gas prices. To what extent is that price dictated by those individual gas stations? How much of it is the oil company's oil price. I mean, what's the breakdown?
Right. So despite rising profit margins, the cost of oil is still the biggest factor in gasoline. And rather than thinking that it is the sellers that are dictating the price, I think the biggest factor there is the lack of refining capacity. I mean, we have actually lost refining capacity in the United States, and we'll probably never have a new petroleum refinery built in the United States. So that's a bottleneck. Even when oil prices are low, we have a bottleneck on refining. And I think that constricts supply, and that gives retailers pricing power.
Rick Newman, thanks so much for breaking this down for us. Really appreciate it.
Bye, guys.
See you.
Well, nearly 3 in 4 Americans say they don't feel financially secure at the moment. That's according to a recent bank rate survey. 41% point to insufficient retirement funds as a factor that's keeping them from financial security. We want to help change that by getting you retirement ready. And here with a 5-part retirement checklist is Jean Chatzky, financial expert and Opportunity Knox financial coach. Jean, let's start with that list. What's on the top 5?
Yeah, absolutely. First of all, nice to see you. Thanks for having me. First thing that you have to do is figure out what your retirement looks like. And I know that that sounds really obvious, but in particular, we know that there is often a disconnect between couples. When are you retiring? Where are you retiring? What will you do day to day in your retirement? Will you continue to earn some sort of an income, as many people do? You got to scope that out. And then you have to, part 2, step 2, figure out how much that's actually going to cost. Putting numbers together with your plan. A lot of people are banking on old math. They're thinking, well, my retirement life is probably going to cost me about 80% of my pre-retirement life. That was true for some of our parents and some of our grandparents, but we're retiring younger in some cases. We're retiring healthier in a lot of cases. We've got more years to live. And so figuring out where that money that you are going to come up with is actually going to go, what it's going to fund, how much housing is going to cost, how much transportation is going to cost, how much travel you want to do, how much you're banking on for healthcare. That's an integral part of the equation. And a lot of people have no idea where their money is even going day to day. So that is a good place to start. Figure out where your money is going now. If you're feeling like you're at a loss with that, my coaching program, which is called Finance Fix, it's a program that we developed at hermoney.com, can help. It helps you get in touch with your money so that you can save a little more, spend a little less, and start to make progress towards your goals.
Jean, you'll have to forgive me for reading ahead on this assignment as well in this top 5 list. Number 3 talks about the sources of income. And I mean, I've always been taught you got to have 5 streams of income. I'm working on it to all the people that told me that growing up. But where within your retirement checklist do you advise people on where they can find different sources of retirement funds?
So these days, most of us don't have pensions with the exception of Social Security. I'll come to that in just a second. We do have retirement accounts, and we've been told accumulate money in these accounts. Well, now we're in a position when we look retirement in the face where we have to say, all right, how do I take this sum of money and make it last as long as I do? And there are additional strategies that you need to dig into that involve coordinating taxes so that you're pulling the money out of the right accounts at the right time. That you think about things like, do you want to craft a retirement paycheck using some of that money to perhaps buy you an annuity that will provide a stream of income that will last as long as you will last without having to worry about it? And when it comes to Social Security, people without a strategy for when they're going to take Social Security leave a lot of money on the table. In particular, for the higher earner in the family, you want to try to wait as long as possible between age 62 and age 70 before tapping Social Security, because for every additional year you wait, you get a bump in benefits equal to about 8%. That's a guaranteed return, and it's tough to beat on a year-to-year basis by putting your money into a diversified portfolio of investments.
Finally, looking at number 4 and 5 on your list, how do you think people should be thinking about long-term care? And ultimately, that last part, getting help. What do you advise people?
So when it comes to long-term care, this is particularly important for women. We're going to outlive the men in our lives. Many of us who are partnered will take care of the men in our lives. But then when it comes to our own care, we should be looking into a bundle of benefits that will pay for things like nursing home care or at-home health care, unless we've got enough money to pay for those things ourselves. It's a complicated product, comes in a lot of permutations, which is why getting help is number 5 on the list, and it's paramount. If you are more than 10 years or 10 years or so out from retirement, if you're around 50, 55, and you have yet to go through a pre-retirement checkup that puts you through all of these steps, that looks at whether or not you're well situated to embrace the retirement that you want, it's time to have that checkup. You want to have it with a financial advisor who is a fiduciary, who has your best interest at heart. And you want to make sure that you lay out a plan that you can follow for the next decade. It may change. That's okay. But having a plan is the only thing that will really get you going.
Certainly good advice there. A lot of people taking notes. Jean Chatzky, good to talk to you today. Really appreciate the time.
Thanks.
Coming up, the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned.
The closing bell on Wall Street ringing right now. You've got ticker symbol CPT ringing the closing bell right there at the NYSE. Now time for a check of the markets, sponsored by Tasty Trade. All the U.S. major averages settling right now and in positive territory. The Dow Jones Industrial Average, you're seeing that flat, just barely to the upside right now by about 0.1%. We'll be generous and round that off to S&P 500, you're seeing that settle higher by a little more than 0.25%. And the Nasdaq Composite, that closes in the green to round out our trifecta, or the hat trick, or the triple-double, whatever you want to call it. Call the Nasdaq.
Oh, triple-double.
Yeah, triple-double. Yeah, you're a big basketball fan.
Yeah.
We like that. All right, cool.
Positive.
Well, here we are in the NBA offseason, so we've got to figure out other things to do, like listen to music. Shares of Spotify, they're tanking today, following second quarter results that disappointed investors as gross margins missed analyst expectations. The music streaming giant also hiked the cost of its premium subscription. Let's take a look at shares right now. They're down by about 14%. That's where they end the day. So not quite its worst trading day on session, but it ain't great here. Ultimately, we were looking through some of these results. We've got Ali Canal here with us on set to help us really round out this conversation. Wasn't quite a miss on the MAUs. They beat in that category, though.
Oh, yeah. Subscribers is doing very well. Paying users doing very well. It seems like investors are concerned that the price hikes, which went up by $1 for the premium plan, that's going to negatively impact subscribers moving forward, which has really been the lifeline for this company. Another metric that investors have closely kept their eye on is gross margins. That disappointed in the quarter. It's been declining. We did see an upbeat surprise in the last earnings report, which did fuel some gains then. So I think the fact that we're reversing that right now is a concern for investors. But a lot of this has to do with a few different headwinds, one being foreign exchange, another being the fact that royalties, the cost of royalties are higher. And also Spotify is streamlining its podcast business. So there are greater losses around cuts to that unit. I think there's going to be continued cuts to come based on some of the results that we did get here. We saw revenue miss estimates. We saw losses widen. We also saw free cash flow, although it was positive, it was down sequentially and year over year. So profitability just continues to be a struggle for this company. And investors don't really seem to have the patience anymore, but analysts are really preaching the long-term game for Spotify.
Yeah, although interesting when you look at podcast advertising revenue, right? We've been talking about how much money they spent on that. They reaccelerated to more than 30% year on year. So things, at least on that front, I guess it's about the cost and the investment versus the revenue that's coming.
Exactly. And they say they are going to take a very strategic approach to their podcast investments. So that means really leaning in on the podcasts that are doing well and getting rid of those that maybe aren't. We saw them part ways with Prince Harry and Meghan Markle. That was a very
costly
endeavor. So that's something that they're going to continue to do throughout 2023. But clearly right now, with the stock down so much, investors weren't too happy. But look at that year-to-date performance. I mean, it's up more than 75%. So this is a stock that has really battled back some serious lows.
Let's talk about another stock we've been watching closely today. Shares of 3M closing today higher following the company's latest earnings report. The industrial conglomerate posted $7.99 billion in revenue, beating analyst estimates of $7.87 billion. The company also raised its full-year earnings guidance and reaffirmed its revenue guidance. Guys, this is a company that is still very much in transition. They've really leaned in on the high-growth businesses like climate tech, like semiconductors. There's still a big overhang, though, and it is the legal settlements for this company. There is the settlement, the $10 billion settlement from last month on the forever chemicals that we like to call contaminating drinking water. There's a slew of liabilities that they're still having to clear. That continues to be an overhang, but when you take that out of the picture, things looking to the upside for the company.
Yeah, and like we've been talking about with a lot of these companies and their earnings, if you're able to boost that outlook and boost that guidance, that is a positive and you're going to be rewarded by investors. I also think a company like 3M, which is very diversified, it helps. So you can lean on different sectors of the business. For example, automotives was very strong in the quarter. Healthcare was also up slightly. That helped offset some of those lower growth units like safety and industrials, for example. Those sales fell 5.4% in the quarter. But you're right, despite despite that large second quarter loss, the fact that we did get that adjusted profit beat by a pretty significant margin on top of that outlook raise, I think that's a positive for 3M moving forward.
Absolutely here. We're also tracking shares of Disney this afternoon. Shares of the House of Mouse closing the day in negative territory, down by about 1%, following a downgrade to underperform from neutral by Atlantic equities analyst Hamilton Faber, who also lowered his price target on the media giant from $76 from $113. Faber citing concerns around Disney's linear advertising, saying it's clear that advertising is set to fall far faster than they have seen previously there. And you're seeing that reflected in the shares of Disney here on the day as well, Allie.
Yeah, Disney is just a company that's dealing with a few problems, right? I mean, we have this slowdown in their franchise business, the box office, for example. We've seen some of those Marvel movies struggle, and that's going to have a ripple effect to Disney Plus. Coupled with that, we've had an animation slowdown of sorts, and then in the background is this double Hollywood strike, and we're already starting to see the impact there with the company reportedly pushing some of those film schedules to adjust for the strike. So that's something that we're going to continue to watch. Outside of films, there's the uncertainty surrounding the macro environment. You mentioned the decline in linear networks. I mean, Bob Iger, he's clearly not married to them. He already hinted that he would be open to selling some of those TV assets, but who would be the buyer there? So there's a lot of uncertainty. Sports is continuing to do well, but then there's the question of when Disney will take ESPN fully over the top. There were reports that they're already holding strategic partnership conversations with major leagues like the NFL. We'll see if that comes to fruition, but there are a lot of unanswered questions when it comes to Disney, and a lot's going to be riding on this earnings report.
A company that really clearly wants to accelerate into digital, but still has the weight coming from linear. A lot of transition still happening on that front. Another stock we're watching is Chipotle. The company set to report earnings at this time tomorrow. Our very own Brooke DePalma is here with a preview. Brooke.
Good afternoon, Akiko. That's right. Its second quarter earnings results are expected to be reported Wednesday after market close, and Wall Street pretty optimistic about this one. Revenue expected to come in at $2.54 billion, up 14.5% year over year. Adjusted earnings per share also expected to be higher year over year, up 34% to $12.24. Now, same-store sales getting lots of drivers here, including increased foot traffic, that limited time offering, the Chicken Al Pastor, and a pause on price increases earlier this year. That same-store sales number is expected to jump nearly 8% year over year. Now, taking a closer look at that foot traffic that is expected to drive same-store sales this past second quarter. In June, foot traffic was up 14.7% year over year. May up also 17%, and in April 15.2%. As you can see here, according to Placer.ai, that's far higher than its fast casual peers. So think far higher than Kava, than Sweetgreen, among many others in the fast casual space. And holding prices seems to be working for the fast food chain, as well as winning over analysts on the street. From TD Cowen, they're saying Chipotle's value perceptions are outperforming the fast casual peer group at a widening clip. Wedbush saying something similar, saying that it's well positioned to regain its value advantage by holding menu pricing peers below in 2023, which could drive accelerating transaction growth as the second half of the year progresses. Other items or other results that analysts are looking for on the street is how far they are moving along as far as unit expansion goes. William Blair saying in a note that they expect 8 to 9% this year, ramping to 10% over the next few years. Of course, earlier this month, Chipotle announced plans to spread or expand rather to the Middle East. And of course, analysts continuing to watch that robot expansion. Of course, they recently announced the Autocado and Chippy, an Old Town favorite, only about a year old now.
Yeah, I'm sure that's going to be mentioned on the earnings call quite a few times. But Brooke, you mentioned the Chicken Al Pastor. What's the hype there? What are Wall Street analysts saying about that?
Well, really, food inflation continues to be a story that we continue to watch in 2023. And according to TD Cowen, the Chicken Al Pastor has actually outperformed last year's Pollo Asado. And so it is now going to be what they expect to be the most successful protein limited time offering. Now, it's important to note here that beef makes up about 20% of Chipotle's food basket. Avocados make up about 9%. And so with those two items being a go-to for consumers, those are facing higher prices, but chicken prices moving lower. And so ultimately, if we saw more consumers move towards that, perhaps it helped Chipotle's food basket as chicken prices continue to lower. And so lots of food inflation, unit expansion, and lots of foot traffic expected to be the top drivers of this quarter for Chipotle.
All right, Yahoo Finance's own Brooke DePalma, thanks so much for covering all of that and keeping a close eye on the tastiest part of the markets, perhaps here. Appreciate it, Brooke. All right, switching gears here. Shares of Alphabet are trading higher after reporting earnings. You're seeing an immediate reaction of about 5% to the upside in the extended hours move right now. Let's break down some of the numbers for you. It was ultimately a beat on top and bottom lines here for both EPS and revenue. Taking a look at the earnings per share, that came in at $1.44 in the diluted EPS there. And then revenue, that came in at about $74.6 billion. That ex-TAC revenue that you're looking at on screen, which is what a lot of the analysts and investors pay close attention to, that coming in north of $62 billion there. And breaking down one of the other big announcements that came within this second quarter 2023 earnings release. They have also announced plans for chief financial officers, the transition there, an appointment of a president and chief investment officer. So the CFO of Alphabet and Google, Ruth Porat, going to be transitioning into a new role here and reporting into Sundar Pichai. Also want to mention a few other just quick call outs here. YouTube revenue, also worthy of note here as investors pay close attention to this grappling for consumer attention in the screen wars here. YouTube, that brought in $7.66 billion. It'll be interesting to see what more color they give on the earnings call as well, especially given the fact that this is another company that was investing heavily in generative AI as well to try and maintain its dominance in search.
Yeah, investors looking for a little more color on integration, how they plan to integrate the technology there. But that news on Ruth Porat, certainly a pretty significant one there, just given her helm as CFO there for a very long time.
Yeah, certainly. And I mean, you think about the number of different areas that Ruth has really had to govern the financials for this company over, whether that be the other bets and just how much they were spending in areas like Waymo, or where they were putting that forward in terms of other investments to try and make sure that they weren't missing out on the cutting edge of technology where it didn't make sense for them to home grow something internally. And so for Alphabet and the powerhouse and the capital cash that they've been able to put to work in making sure that they can either acquire to grow or build something internally that incrementally allows them to grow and add on to other offerings that they either take to end consumers within households or taking to other businesses in the form of cloud. And since I mentioned cloud as well here, this is a company that's very important to pay close attention to here. That cloud revenue line item, that brought in about $8 billion for the company. So this is largely, and of course comes as no surprise here, still an advertising company, but has been looking to make sure that they are able to capitalize more on the cloud. Important to note that if you compare this to the same quarter last year rather, they were actually able to swing this to a net income operating gain here. Last year, the same quarter, it was a loss of about $590 million. They saw a net income of about $395 million for this second quarter this year.
Okay, let's talk about the other big tech name that's now reporting their results. Shares of Microsoft under pressure in after hours here, down now more than 2%. When you look at the numbers, a solid beat both on revenue as well as earnings per share, but it really is about the outlook here for the company and concerns about continued slowdown in investments. So let's walk you through the numbers here. Revenue coming in at $56.19 billion, earnings per share at $2.69. Some numbers we like to look at in terms of where things stand. Intelligent cloud revenue at $23.99 billion. That's also a beat pretty close to where estimates were. We're also seeing operating income coming in at $24.25 billion, CapEx at $8.9 billion. One thing that we've been watching, on the one hand, there's been an excitement around AI and Microsoft's investments there. There's also sort of where their core business has been, and that has been in enterprise here. When you look at revenue and more personal computing, that came in at $13.9 billion. It was down 4%. Windows OEM revenue decreased 12%. And that's something that we have heard in terms of companies increasingly sort of maybe pulling back some of their investments in the face of what is more of kind of a cloudy cloudy outlook on the macro front. Now, the big question here going into the call is going to be, well, how are they going to be monetizing AI? What does that growth prospect look like? Satya Nadella in the release saying organizations are not only asking how, but how fast they can apply this next generation of AI to address the biggest opportunities and challenges they face safely and responsibly. He goes on to say, we're focused on leading the new AI platform shift. Is that going to be enough to really get investors excited beyond what has already been built into the stock here and the potential for additional growth coming from AI technology?
No, it's a great point. And I think as we were talking about this earlier, coming into the report, it's really going to be about how much on the call they disclose about the level of spending that they're comfortable continuing to put forward, whether that's investments in other entities like OpenAI and whether they add incremental investment on top of that, considering the head start out of the gate that OpenAI has had in some of their research development and actually bringing a product to market that everybody and their grandmother is talking about. If they're at the summer barbecue, everybody wants to know about ChatGPT. And so at the end of the day, for Microsoft now, where do you further that investment into some of your other tentacles that you have that round out this holistic MSFT umbrella here, whether that be AI within LinkedIn, whether that be AI within some of their advertising products within search engine as well. Investors want to hear the answers about when that's going to be monetized and when that trickles through to some of the margins too.
Yeah, and we did kind of get a preview of that, right, when Microsoft announced some of their pricing strategy last week, $30 a month in terms of use of their generative AI with their Copilot service on top of what companies are already paying. Yeah. So we're getting a glimpse of how enterprise customers are wanting to integrate that. It is about how quickly that growth will come and how quickly the revenue is going to come in.
Yeah, spot on here. Let's also talk a little bit more about some earnings that have come through. Shares of Snap, they are plunging right now by about 16%. We'll round that off to a little more than 15% right now after reporting earnings. Ali Canal is here to break down the numbers for the brand of Ghostface Chilla.
Yes, and this share reaction is largely due to forecasts that came in weaker than expected. But we did see a beat on both the top and bottom line. Revenue coming in at $1.07 billion versus the estimated $1.05 billion. Now that's a decrease of 4% year over year, and it marks the second straight period of declining year over year revenue for this company. We did see a narrower than expected loss for adjusted per share loss of 2 cents versus a loss of 4 cents that was expected. Global daily active users also beat estimates, 397 million in total, whereas average revenue per user, another beat there, $2.69 versus the expected $2.67. Now, when we go to the forecast here, they do see third quarter adjusted EBITDA losses to amount between 50 million to 100 million. That's assuming that the company's daily active users will reach between 405 million and 406 million. Now, Snap has been aggressively trying to reshape its business. They said they're going to continue to invest in AI, other infrastructure to improve the performance of its ad platform and drive deeper content engagement. A lot of the experts we've been speaking with have said content engagement is going to be key, especially with those younger consumers like Gen Z and millennials. On the call, I'm sure investors will be very tuned in on the health of Snap Plus, what those subscriptions are like, how that could add to average revenue per user. Snap, I should say, also saying that the forecast assumes modest sequential headcount growth as we continue to carefully calibrate our operating investments to focus on the inputs most essential to the acceleration of top line growth. Again, that's Q3 adjusted EBITDA expectations between 50 million to 100 million there.
You know, this is a company that could face a ton of questions on this earnings call, just looking at the stock reaction. And as investors and analysts who are going to be pegging the executives with questions on that call when they get the chance, I think back to the previous earnings call that took place when Rich Greenfield was asking them the question of, should you be scaling back the purchases or at least the capital that you're expending right now on even some of the augmented reality features that you're putting into this platform? And it's a larger question of the cost restructuring that may need to continue to take place. Snap, I think, had pushed back saying we already put much of that forward, so we're confident now in the way that we are moving and in how much we're spending and in where that goes into different AI chatbots on the platform or whether that is to enhance the content experience too. But in these screen wars, Snap had acknowledged years back that everybody from Netflix all the way to a TikTok is their competitor. And that's a wide range of people that are vying for consumer attention right now.
Yeah, instead not always really kind of assessed or valued. It's sort of, sort of the tech play as in, they were very ahead on AR. They have been incorporating AI as well. It's not necessarily valued the same when you compare the excitement around it. You should note, by the way, Meta shares up nearly 2% here now and after hours too, because it's interesting always to see the reaction between what's been playing out in Snap tomorrow, Meta reporting. That stock though, maybe in reaction to what's happening with Google as well and digital ads there, but up nearly 2% right now.
Just one last note here. We've been looking at the plusification of everything, essentially. Snapchat Plus, their subscription service that offers exclusive, experimental, and then additionally pre-release features, that reached 4 million paying subscribers in Q2. That's 1 year after launch, they're noting here as well. So perhaps we'll get a little bit more color about that and what their pricing strategy might be in the future as well.
Competition's still a big question.
Yeah, exactly.
Big concern.
Yahoo Finance's own Ali Canal joining us to break down some of the numbers this afternoon. Thanks so much, Ali. Let's do a quick check of the market sponsored by Tasty Trade. Let you know where things ended today's trading activity. The Dow, S&P 500, and the Nasdaq all ended the day in the green. The Dow flat just barely to the upside. S&P 500 fractional gains there as well. 0.3%. We'll be generous and round that off too. And the Nasdaq Composite, you're seeing gains there of about 0.6% as we closed out the trading session.
Well, tech giants Microsoft and Alphabet are out with their latest quarterly results. We have Ted Mortensen, Baird Technology Desk sector strategist, with deeper insights into what is catching investors' eyes. Big names here reporting. We are seeing stocks moving in the opposite direction. Let's start with the one that's under pressure here. Microsoft, we're seeing a beat on the top and bottom line here, but it is about the decelerating growth here, particularly around cloud. What's your takeaway on that front?
Well, first of all, Azure was the main focus here. They had guided 26 to 27%. They came in at 27%. I think a lot of people were looking for a higher number, deliver on Gen AI, on loads of Gen AI. It's very obvious that the enterprise now is still in this optimization stage of looking at their cloud spend. So that's a little bit disappointing, and people are looking at a higher number there.
Is it unrealistic of investors to expect, though, a monetization of generative AI this soon in the game for even a powerhouse like Microsoft?
That's the right point, but Satya has been very, very aggressive in his narrative on OpenAI, and I think people we're looking for a little bit better on those loads. Generative AI it's not a flip of the switch, and you asked the right question. These are re-architectures of data stacks and infrastructure, and it does take a long time. So, you can look out about a year out and you'll start to see it hit the model, but there is a fair amount of high expectations with Microsoft being up 46% year to date.
Yeah, and Ted, you could argue maybe a slight pullback is needed given the excitement.
Healthy.
A healthy pullback, we should say. When you look at Microsoft, always a good pulse of just where enterprise is spending right now. Given the deceleration we've seen on that front as well, what does that tell you about where companies are putting their money?
I think this is the optimization trade. Everybody's really looking at their IT budgets pretty aggressively. That's nothing new. With our conversations with CIOs, Microsoft is kind of the Death Star of technology. They are swimming totally out of their lanes. They're innovating faster than anybody else. They're using their $17 billion cash flow per quarter to really integrate AI into areas like development tools on GitHub, which I think is going to be very strong, as well as moving into security. So when I talk to CEOs or our analyst tech team talk to CEOs, one thing comes out. Microsoft is becoming a line item in budgets. And I think along with every single company in tech, those IT budgets are not infinite, especially in 23.
I think something that you just alluded to is really noteworthy here, in that we've moved past this kind of hype phase or narrative selling cycle, or part of the cycle for generative AI, and for a lot of tech companies and even non-tech companies that had said that they were going to be able to benefit and leverage from it. No doubt that could be true, but now that we're in the prove it phase, how many other companies kind of across the spectrum here could be set to face some tough questions from investors and ultimately perhaps see their stock prices react in tandem?
That's the right question. I mean, I sit on over 70 calls a quarter on tech, and I'd say 90% of the CEOs are saying they're generative AI companies. Some are, and some are somewhat imposters. And I think you're going to see the companies where the emperors don't have clothes, and then the companies taking massive share. It's more of a platform sell, and there's some infrastructure picks and shovels that are going to do extremely well. But not everybody is going to catch this wave. It takes a lot of free cash flow and a lot of engineers.
Finally, Ted, we're watching shares of Alphabet moving in the opposite direction. Certainly a number of things to hit on in terms of what investors are watching there. It is the monetization of their AI technology. It's also about the growth they've seen in YouTube and digital ad spend. What's the one that you think really is leading to these gains? I mean, to what extent is a 6% pop here justified?
It's, if you look at Google, Google's up, I want to say about 39% year to date. So it's a little bit below the Microsoft gains, but it's all advertising. Advertising last quarter was somewhat muted, and this improvement on advertising is noteworthy. Also, I think if you look at GCP, which is their cloud offering, it's solid growth of, call it 28%. So they're one of the big three between Amazon and Microsoft, and very, very poised from a cloud standpoint. It's an engineering company, and I think some of the Gen AI, privates are using GCP because it's much more flexible on APIs, and quite frankly, they've been a pioneer for a long time on AI infrastructure.
Just lastly, while we have you here, Ted, I mean, the street has become used to hearing from Ruth Porat in one facet or another, and now there's going to be transition as the search commences for a new chief financial officer. What do you believe this next iteration of that position particularly could hold? Is it one of kind of extreme cost measurement, even more so than Ruth has done over the years, and having to monitor where some of that spend is going out the door and where they're able to monetize very well-oiled parts of their business?
She's one of the best CFOs in the business, if not, the top 5 CFOs in the business. And the investor community had a tremendous amount of trust with her. She was very much of a straight shooter and quite frankly, had a very good command of the numbers. So the person coming in is going to have to be that type of person. CFO communication is key with the institutional market. And, Google's going to have a hard role to find to really take advantage of having Ruth in the seat for so many years. It's been a blessing for the company. She's an all-world CFO.
Certainly have been at the helm, the steady hand at the helm for many, many years. Ted Mortensen, it's good to talk to you today. Appreciate your insight.
Okay. All right. Have a good afternoon.
Well, coming up, Snap shares plunging after hours amid its third quarter guidance, missing expectations. We're going to break down the numbers on the other side of the break. We'll be right back. Shares of Snap plunging on third quarter guidance despite beating on earnings. For more on this, we turn to Scott Kessler, Third Bridge Global Sector Lead for Tech, Media, and Telecom. Scott, good to talk to you today. A huge decline is what we're looking at, down more than 17% here. What do you think? What's the street not liking?
I mean, look, this is not surprising. I think Snap has got to be one of the more volatile names within this category and even across TMT in conjunction with quarterly results. I think it's really more of the same. I feel like I've seen this movie at least once or twice before, where Snap essentially is indicating that there are some challenges. The challenges could be coming from the macro backdrop, could be coming from the fact that, they've been overhauling their ad technology and platform, or the fact that it is in fact a very competitive market. All that put together means that there are, I think, continuing issues that Snap has to overcome, and investors are not especially patient, especially at this point.
Scott, you read a report like this, you see the share price reaction. Sure, year to date, they're up by about 40%, but with all of the competitive factors that are in the market right now and the ways that consumers' attention are being pulled in one direction or another on either user-generated content or just consumption of that content, can investors still feel comfortable holding Snap?
I mean, to be honest, I don't know how people can feel comfortable, especially given the implied decline in the share suggested in the after-hours trading. That being said, however, I think it's appropriate to kind of wait and see in terms of what the company has to say. Look, the company announced a pretty major restructuring a little less than a year ago. I think it was August of last year. They talked about prioritizing, things like user growth and revenue growth and essentially AR and VR, presumably monetizing that. They're focusing on those things. But really, to be able to truly execute, they need to be able to get their advertising technology and platform in place. And it's taken them a lot longer than people might have expected. And it's had a negative impact on their ability to kind of drive monetization. And that's what people want to see at this point. I think that the company would be well advised to hopefully indicate that they're in position to kind of relaunch the ad platform so that they can really benefit from what historically has been a really strong period for them, and that's the holiday shopping season. So we'll see what they say there.
In prioritizing some of those features, Scott, at what cost, though, here? Because it seemed like in the previous quarter, that was the question that many analysts got ahead of. How much are you willing to spend to continue to prioritize some of these efforts, knowing that you're in a corporate advertising spend slowdown or kind of lull period?
Yeah, look, I mean, I think these are things that they need to do. They've already embarked on this spending, so they can't just stop midstream. Nonetheless, I do think it's reasonable to ask, when is this going to be done, and when are you going to start being able to, flip the switch and be able to really capitalize on the investments that they've been making for a number of quarters at this point? I think those are very reasonable questions. I also think that people should be wondering about other monetization efforts. We spoke with an expert not that long ago who pontificated that, yes, monetizing Snap Map is an opportunity, maybe a priority, but not something that we should expect until next year. I think sometimes with Snap, it seems like there's a lack of a sense of urgency coming from company leadership. We clearly saw that urgency when the company announced a pretty massive restructuring last August. But since then, I think people are kind of wondering when the benefits of that restructuring are really going to manifest themselves.
And Scott, we didn't even get to the competition discussion of all of that, but certainly a lot to talk about when it comes to Snap stock. Scott Kessler, appreciate your time today.
Thank you.
Switching gears, shares of Whirlpool sinking today as the company saw weaker demand for its products this quarter, despite signs of inflationary pressures easing. Whirlpool's Executive Vice President and Chief Financial Officer, James Peter, spoke with our Yahoo Finance morning team about the most recent quarter. Take a listen.
What we're seeing in terms of demand, you could probably break down into 3 different buckets here. And if you think about our business, there's a big part of it that's replacement, and that's 50 to 55% of the appliances we sell. And that segment is relatively stable and strong, and pretty predictable. The next part is what we'll call discretionary spend, and that's about 30% of our business or 30% of the industry. That's the segment right now that I would say the consumer is still relatively tentative in. And part of that is driven by existing home sales are still relatively low. And if you think about it, when people buy an existing home, one of the few things they do change out when they move in might be the appliances. So that segment right now we would say is below where we expected, but is relatively stable. Now, the last part of the industry in our business, which is about 15% for us, is new home construction. And we're beginning to see that pick up. And I think you've seen in the last couple of weeks, a couple of the large builders come out and be rather positive. And we're seeing the same thing. We're beginning to see their business pick up, which means in about 6 months, our business picks up as those homes are completed. So, as I said, it's probably a mixed bag on demand within the U.S. And then if you go outside the U.S., part of what impacted us within the quarter is that demand in EMEA was down by about 10%. And that's just the macroeconomic environment there and lower consumer sentiment. But as I said, in the U.S., we are positive on the demand in the future, and we do believe we'll begin to see some of that pick up. And with people who can't find existing homes, many of them will turn to remodels at some point, which then falls in that discretionary bucket for us.
Jim, it's Brian here. Good to see you as always. How fast will that rebound in the U.S. housing market take place? This week, we're supposed to get what could be the last interest rate hike for this cycle from the Federal Reserve. What does that mean to the next 6 to 12 months in the housing sector?
Yeah, no, that's a good question. Like I said, we're already seeing the signs of new home construction pick up as, people who are in the market for a home and couldn't find an existing home due to low inventory. And the reason there's low inventory, as many of us know, it's with mortgage rates where they are. Nobody wants to give up on their, 2.5%, 3% mortgage to take on a 7% mortgage right now. So we expect to see that pick up in new home construction, over the next 6 to 12 months. I think then as you look to next year, we would expect to begin to see as interest rates stabilize and it's kind of been absorbed and normalized within the marketplace, you'll begin to see some of those existing home sales pick up. But, right now I'd say new home construction will be the first thing to show signs of growth.
And Jim, for the people who are buying new appliances, what kind of choices are they making? Because I know you guys have, you've been doing more sales, more promotions, but at the same time, you've been leaning into some of your higher end stuff. I know you guys bought InSinkErator. I am an InSinkErator owner myself with a kitchen reno that I did. So how many people are making those higher end decisions right now of your customers?
Yeah, I would say, the mix, and first off, thank you for buying InSinkErator, but the mix of our customers we see right now is relatively stable and pretty much in line with what we saw, historically and especially pre-COVID. Now, as I mentioned, as new home construction picks up, what you do start to get is a disproportionate amount of kitchen appliances because every new home takes on average around 5 appliances, the majority of those being kitchen appliances. So, that's the categories that we expect to see pick up. I'd say right now, though, our balance of sale or our mix of product is relatively similar to what had been in the past, as well as our mix of brands. We still are seeing the consumers buying in the premium space and also in the mass space. So despite the fact that the promotional environment has returned to levels that we would have seen before COVID, I'd say, consumers are still buying at that premium and especially that mass premium segment right now.
And Jim, I put this question to General Motors CFO this morning, and I'll put it to you. Do you think inflation has peaked for this cycle? Are you confident that you can say that?
I would say, listen, from a material cost perspective, we saw the peak probably late last year. And if we look at other costs, our logistics costs have come down. I'd say labor is the one cost that, what I would say is that Inflation is probably steadied there, and it's at a more typical rate. Obviously, I don't think labor costs will come back down, but we have seen, we talked about our material costs for the year. We saw about a $300 to $400 million deflation in our total material costs. And in our logistics costs and other things like that, we saw similar levels of deflation. So I do believe, at least for our business, when you take it in aggregate, inflation has peaked. But if you break it down among the components, there's still a few areas where we are seeing some inflation.
Our thanks to Whirlpool's Executive Vice President and Chief Financial Officer, James Peter, as well as the Yahoo Finance Morning Crew. Coming up, we're going around the horn and checking in on some of today's top stories. Stick around.
Welcome back to Yahoo Finance Live. We're talking the top stories of the day. We have Akiko Fujita joining in on the conversation along with Pras Subramanian. And Pras, I want to start with you because you're looking at an EV car that's back from the dead.
The Bolt is back. The Bolt is
3 months after.
Yeah.
It was a short death. It was a short death.
Yeah. So today on the GM earnings call, Mary Barra, in the beginning of the call, said that the Chevy Bolt EV, which they said was ending production last quarter, is not coming back as a next-gen model. Next gen, by the way, is a corporate buzzword, which we will get to later. Anyway, it's called the next gen Bolt EV. It's going to come back. Like I said, going to be powered by the Ultium battery platform, which is, according to GM, going to be a cheaper platform from the build on. The new car I imagine, will likely be in that same $30,000-ish price range, because that's where the Bolt made its money, right? It is a cheap EV for the masses, and GM sold more than they ever have in the last 2 quarters. So it was surprising to see it go, but I'm not surprised to see it come back.
What's interesting to me is the number that GM threw out, which is 70% of drivers who trade in a vehicle to get the Bolt traded a non-GM vehicle. At the end of the day, when you think about the EV transition, it is about GM trying to appeal to a wider swath, right? We're at 5% market share right now in terms of new buyers, EV sales. GM is the name, as well as Ford, that's supposed to get it to a much wider spectrum. So not only is it people who are buying in on GM who usually wouldn't. It's also the price point. And that's why it's interesting that just 3 months after the fact, they're bringing it back.
Yeah, and what do you think the price point will mean for a company like Tesla, especially since we're seeing these pricing wars occur? I'm curious, did Tesla have any price stock reaction after the news broke with GM?
I didn't see any reactions to that. I know that the Model 3, if you include the federal tax credit, is like 33,000.
Well, I mean, that's the key, right?
So that's competing in that same class. And right now, I think GM thinks that if they need to compete against the Tesla Model 3, they got to make the Bolt better, and that might include that Ultium platform.
Well, and we're talking about $7,500 tax credit. That's federal, but if you've got states, which I always like to bring up because in California it's $7,500 on top of that. I mean, that is a steep discount when you think about a Model 3, which is why you see them everywhere in California and many other states too, right? So GM is going into that market trying to compete. It is about a lower price point, and I'm curious if we're talking 5% to get to 10%. Where is that market? Is it in sort of these trucks, you know, the F-150 Lightning, these other trucks that are selling at a higher price point? Or is it on the lower end from drivers who are saying, I don't want to be paying gas prices, but I also don't have $70,000 to buy a new car?
I think if we're going to get even past 10%, it's got to be at that lower end. The middle class buyer that wants to go into electrics, when right now they're being priced out. They don't have that many options aside from the Bolt, which they're getting rid of, right? So that's going to come online. I think you're right.
The Leaf, you forgot about the
Leaf. The Leaf, but the Leaf, I don't think is competitive in terms of range. But I think you're right. I think trucks too, because trucks are such a huge. The biggest market in America is trucks. If you can make those trucks cheaper and good range, I mean, that's what it is.
I mean, we're seeing EV adoption pick up across the board. So I'm very curious to see the sales for those Bolts. But speaking of driving, I want to move on to what's driving the economy. And that's Taylor Swift, Barbie, and Beyonce. Okay, we're in this Goldilocks economy right now. We're not too hot, not too cold. But post-COVID, we've seen this surge of people wanting to dive into experiences, live events. On top of that, we have a work from home situation, which makes it a lot easier to travel. So Axios is out with this new report citing Moody's about how people are traveling more to concerts, justifying that. I'll work from my hotel on Friday. I'll go to the Taylor Swift concert here. I'll go over here. It's booming local economies. So it's interesting to see this era, and we were just talking about Barbie and Oppenheimer, how that boosted the box office in a record-breaking way, how people are spending money on those things, and that's leading to a boom of sorts.
I am a little curious, and I will say I'm a little skeptical about how much remote work plays into that. Now, having said that, we have seen this huge transition from goods into services, right? So people want experiences, they're willing to shell out money. And with Taylor Swift specifically, I thought it was interesting that the Federal Reserve President of Philly Fed President made a mention of the bookings with hotels seeing the highest post-pandemic, and specifically cited Taylor Swift fans coming into town. And what we're seeing is that people are taking advantage of the excitement. Same thing with Barbie. Yes, they had big sponsorships in place, but they also, your local theater, you're talking about, there are businesses who are trying to jump onto that because consumers are willing to shell out the money.
And there was the same report, museums having like Swift like promotions. People were coming in town, so they're doing other types of tourist activities, restaurants too. Also reading that was it another country that said that in some city they boosted inflation?
Sweden, I think, for Beyonce tickets potentially.
I wanted to ask you about this one thing in particular. So the New York Times had an opinion piece today talking about how women are craving positive women-forward content that embraces femininity too. The writer wrote something to the lines of, the obvious lesson from the gargantuan success of both Barbie and the Eras Tour is that there's a huge underserved market for entertainment that takes the feelings of girls and women seriously. Do you guys agree with that?
I don't know if I would read into it that seriously. Is it? I mean,
if you look at it at the context of the box office, there's not a ton of female-led stories. And I do think there is a desire for new, like we were saying, new original content, new types of storytelling, not the same old that we've been seeing. And you're seeing that reflected in the numbers with some of those Marvel superhero films, some of those more franchises not doing so well. So I do think from that perspective, there is a desire for different types of
People want
content.
new experiences at the end of the day, right? You could relate that to movies. Oh, here we go. See?
Oh my God, he's ready for that.
All right, let's just move on to the next story because Praz is clearly very excited about it. There is a company haystack that is coming up with essentially what is a guidebook for corporate jargon. And I want to pull up this number because I think this is interesting. If anybody who has worked in an office knows there are very specific words that are used that you would never use with your friends in a normal conversation that comes in corporate speak. And specifically, when we talk about that, 60% of workers around the world, this is according to a recent study conducted by LinkedIn and Duolingo, said they didn't know the terminology that was used in their workplace. That's a problem.
Oh, you mean when a new term pops up?
New term pops up. So
they're just smiling and nodding their head.
Okay, let's just open it up. Praz is itching to go here. What is the most hated or the corporate jargon you hate the most? So,
well, Akiko, you kick us off here because
this is, I think, a relatively new one.
Okay.
I've heard it more and more. North Star. The North Star. This is our North Star. This is our goal. This is what we want to do. This is what we want to aim for. No need to say North Star. And I will admit, I don't think this is a term that's used in every single office. I do think it is used in marketing and PR largely, but it's kind of spilled into the everyday office space too.
Okay.
Just goal. What's our goal? This is where we want to go.
Keep it simple.
No need for North Star.
Yeah, mine I would say is low-hanging fruit. I'm scarred by this one from a previous job. It was always a messaging of, we got to go over the low-hanging fruit, which was never technically low-hanging fruit. It was harder than it implied, that the phrasing implied. So yeah, I don't want to talk about fruit in the office. So that would be mine.
All right, mine's a newer one that I heard recently that I think you guys maybe have heard too. The juice isn't worth the squeeze, right? So it's
I have not heard this one.
A task that will produce some sort of benefit, but it's too much work, so it's not worth the squeeze. I hate that. Just say it's not worth doing it. But I have a couple ones that I also hate. I hate ping, like we're pinging people.
I'm guilty of using it.
I use it too sometimes, but it's like we're not sonar, we're not submarine people here. Circle back.
Also guilty of using it.
And mission critical. Mission critical is about. But here's ones that I like. I like Next Gen. I like Next Gen. I like Game Changer. I use Game Changer all the time. I like ROI. What's the ROI?
Game Changers is return on investment.
And my favorite one is the Kendall Royism, seat at the table. Give me where's this seat at the table?
You're leaning into the succession there. Okay, all right, I like that. Well, we're gonna keep debating our favorite and least favorite office lingos. We'll be right back on Yahoo Finance on the other side of this break.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. The Teamsters Union and UPS averting a strike. The two sides announced a tentative deal just days before the current contract expires, and it affects 340,000 employees. According to the Teamsters, the contract includes historic wage increases, air conditioning in trucks, and one more paid holiday. It also eliminates a two-tier pay system. Another deal in the regional banking sector. PacWest and Bank of California announcing they will merge in an all-stock deal as they look to navigate the post-banking crisis environment. PacWest has been shedding assets to try to bolster liquidity. The combined bank will have about $36 billion in assets. And Alphabet shares rising on better than expected second quarter results, but a leadership shakeup is dominating the headlines. CFO Ruth Porat now transitioning to a new role. She'll become the company's president and chief investment officer, but she will stay on as CFO until a successor is found.
Time now to take a look at what to watch tomorrow. Fed Chair Jerome Powell will take to the podium after the Fed makes the latest decision on the path for interest rates. The majority of economists expect the Federal Reserve to raise rates 25 basis points after last month's decision to pause. Investors will be looking for an indication of future potential rate increases before year end, while the Fed remains committed to bring inflation down to its 2% target. And on the earnings front, we'll be hearing from more big tech companies. Meta is next up to report its quarterly results in what CEO Mark Zuckerberg has said this to be the company's year of efficiency. Meanwhile, consumer names like Coca-Cola and Chipotle, they're also set to release earnings. Investors will be looking to get an additional read on consumer behavior there. This coming after consumer confidence saw its second straight month of gains, standing at the highest level since July of 2021. And last but not least here, what to watch, fresh data is out tomorrow morning on new home sales for the month of June. U.S. new home sales advanced in May to the fastest pace in over a year. And as limited inventory in the resale market remains a pain point, we'll look to see if June delivers another rise in sales of new homes.
And that does it for Brad and I on today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.